I didn't want to spend a lot of time on it because I'm kind of the oddball at the table here.
Okay, all right, so Stephen, I'm going to come to you. We've talked now about tokenizing, ownership of fiat. It's been mentioned you could tokenize ownership in precious metals, say a gold bar. Talk to us about the Maker product. What's the variety of stablecoin that represents?
So I'm going to go real simple, real quick. In the stablecoin space, the categorization is really quite simple. Stablecoins that are decentralized and stablecoins that are centralized. That's it. Really nothing more to it. So if you're in the centralized space, you have a risk profile that is attached to you, and a good example of that is Gemini Dollar, TrueSD, Tether, etc. And what that encompasses is all the necessary central party, counterparty activity that you have to control for. So it's really, at the end of the day, a very innovative new type of bank product. And why do I call it a bank product? Because ideally, you need a lot of the funds that are brought in, the dollar that is brought in and turned into a stablecoin, a digital representation of that dollar, needs to be stored somewhere. So obviously, if it's in a bank account, it means it's a part of the banking system. So ideally, you want to make sure you have many of these centralized stablecoins. They're very good, they're very innovative, we do need them, but we need a lot of them. They are constrained by the balance sheets of the institutions that they were with, because ultimately they derive their value from the credit of those institutions, not just by the actual dollars backing. Because if it were, you would need a globally segregated account, separate and off balance sheet from the bank, to which you could actually map the tokens. So those are the risk profiles that come with it. It's not good, it's not bad, it's important that we have them in the space, but it's important that we have many. That's the centralized aspect. The decentralized aspect really starts talking to the idea of, well, you need to scale. You can't be constrained by balance sheets. You can't be constrained by the constructs of the banking world. So what's the next step? What's the next evolution? And that is to be decentralized. So instead of going through the very long conversation about what decentralization means, I'm going to tell you what it provides. And what it provides, and this is what the Maker protocol provides, is two very important primitives, financial primitives from the traditional space, incorporated on the Ethereum blockchain, and as a result creates the DAI stablecoin. And what are those primitives? They're very simple. Collateralization and credit generation. So the Maker protocol is simply a tool. And the amount of stablecoin that can be produced is quite frankly, quite literally, a function of the value of the collateral that you can put into the system. So right now it's focused on crypto-native assets, Ethereum, basic attention token. But the idea is, and this goes to the previous concept of tokenizing, what happens if you could tokenize real-world assets? I mean, I'm not going to go into the major debate here, but for a second, if you could tokenize treasury bonds, in other words, create digital representations of treasury bonds, and slip them into this protocol, you have trillions of dollars of value available to you for the supply of a stablecoin. I am cognizant of the fact that it comes with a hefty debate, but that's just really a thought experiment here. The other aspect about decentralization, and what is really important about it, is that it is a part of the decentralized finance space, which I also like to call transparent finance. And what is really important about that is that you don't need to go to a bank, you don't need to go to an institution to find transparency. You merely have to go to the publicly available blockchain. And from that publicly available blockchain, you can see the full health of the protocol. You can see where every stable coin came from and how it was developed. And you can actually see the movement of stablecoin from and back to the protocol. And the basic idea is this. You take collateral, which you own, for instance, $150 worth of ETH, you put it into a smart contract, let's call it a smart vault. And that smart vault belongs to you. So the collateral belongs to you, that smart vault belongs to you. That smart vault realizes, oh, you've got $150 worth of value in there, and makes available to you the credit generation part, 100 DAI. And each DAI is pegged 1-to-1 to the dollar. So let's go through this again. The collateral belongs to you. the smart vault belongs to you, and the stablecoin belongs to you. This is real sovereignty on chain. This is independence. And that is really what a decentralized stablecoin like DAI and the Maker protocol brings to the table.
So Stephen, help me, I follow that. Help me understand the stable part of this. So you're saying if I have 100 ETH and I can go ahead and collateralize that to create a stablecoin, okay? What happens though, but the price of ETH relative to the dollar is volatile, is moving.
Right.
So what's making that coin stable?
So this goes back to looking at traditional finance. What do we borrow? Collateralization. What does that mean? That means you over-collateralize. For the amount of collateral that you use, you focus on the stable store of value from that, and that is representative of the transference of that value is placed into a stablecoin. So let's have a look at ETH. Everyone knows that ETH is well, that's an assumption, but let me tell you, ETH is volatile, so is Bitcoin. And so consequently, you have governance, and this probably leads on to the next question. You have governance, decentralized governance, that creates these risk functions that say very clearly that if you want to include Ether into this protocol, kindly know that your collateralization ratio will be 150%, because that is what governance believes is the best way to include that collateral type. If they decided that they wanted to use tokenized treasury bonds, you probably find it be 105%. I think this is a concept of collateralization or taking haircuts is not a new concept, and that is really the part of collateralization that is used in the protocol. So as such, as the collateral asset moves up and down, there is a buffer that allows for it to keep its core value. But if it does hit certain levels, there are levers in the protocol that effectively look after the result of that.
Okay, great. Thank you. So I'm going to actually go back to Yusuf now. You guys have mentioned, but at a fairly high level, some of the potential use cases here for stablecoins. So I want to drill down into that because we have, everyone in this room probably has a credit card or a debit card or maybe cash. What is it that you're going to be either you're able to do today with a stablecoin, and what are some of the things that you all think about in the future that stablecoins will allow someone to do?
Yeah. So there's a couple of different use cases of what's the value prop, why stablecoins. What was mentioned before was banking the underbanked, banking the underbanked, making access to money available to a more broader set of folks globally, right? Being more inclusive. I think what's an interesting tidbit of information is, it struck me as strange, but as recently as the 1970s, women couldn't open up bank accounts in the United States without their husbands, right? And that's in the US, right? Think about what it's like in other countries, right? So certain folks may be underbanked, may not have access to bank accounts. What if there was a mechanism by which we can provide access to money to these underbanked? And this is an interesting proposition because certain third world countries, you may not be able to open up a bank account. You need certain minimum, deposits. Some folks can't even get to a bank location. However, with a stablecoin, it is essentially programmable internet money, right? So nowadays, even third world countries have access to the internet via their mobile devices, right? So now we've opened up access to a significant number of global citizens of the world. So that's one piece, the value proposition, making it more the financial system more accessible and more inclusive. But in the here and now, what we've got is, imagine you're a trader and you need to go ahead and send funds from one exchange to another, right? It's 5:30, the banks are closed, right? We're in a truly global market. It's 24/7. You either have to wait for the markets, for the banks to open the next day, or if you had a tokenized stablecoin, you can go ahead and transfer money at any hour of the day, right? So it provides further accessibility in that manner as well. So that's one of the initial use cases that we're seeing today. However, it's adoption is going to be broader than that, hopefully, right? So I do want to mention that, for example, you can use stablecoins to be able to pay for goods and services. Gemini specifically has a partnership with a company called Flexa, where you can buy things at a variety of different retailers like Nordstrom, Whole Foods, GameStop, using a stablecoin, much better than, once again, using Bitcoin. So now you've got, and it's very transparent to the merchants. It's compatibility with existing point of sale systems. So that's another use case. I think the last use case that I'll mention is recently, I think this week, it was announced that BitPay, one of the largest blockchain payment providers in the world, now has opened up what they call their business billing solution, which allows organizations to pay their invoices using crypto, including stablecoins. Once again, you don't want to use you most likely don't want to use non-stablecoins to pay for invoices, but they now allow you to use stablecoins to be able to pay invoices. So everything from retail down to business payment solutions.
Paul, Stephen, either of you additional thoughts on current use and the future? What might we expect 5-10 years from now?
Yeah, there is a massive future in the fact that stablecoins provide a rail underneath other centralized parties that can provide liquidity where the banking and financial system can't really do that. And that's implied in things like talking about payments with companies like BitPay and whatnot. Their stablecoins, like you're saying, can mean that when you make your payment for X number of dollars, it exactly matches what the creditor expected to get paid. And so that's really, really critical. Now, one of the things that we're doing with the PegNet is making the value, disconnecting the value from the actual underlying assets using market forces. And there's a saying in programming that there's no problem you can't solve with one more level of indirection. So by creating a disconnect and allowing the markets to tie the prices to the assets, that means that the assets can be negotiated in one economic sphere and then be traded with another economic sphere using the cryptography without the problems of centralized control. Because one of the things we haven't touched upon with the banking and financial sector is the jurisdictional friction of transactions that are clearly and provably legit and don't involve any kind of organized crime, but all of the mechanisms to try to understand the provenance as it changes hands one through another creates friction. And so the stablecoins are just going to work with the banking sector to allow value to move quicker and faster and still support the banking sector in various economic spheres.
In fact, I agree with that because the one refrain you constantly hear, very much something that's moving into AI and trying to transform across to blockchain, is that blockchain is going to usurp, substitute, take over the traditional world. And as Paul just mentioned right now, it really is a case of developing an economy on-chain that dovetails with the traditional world. This is not a place where you disintermediate banks. This is where banks take the opportunity to include this into their architecture. They can include it, they can actually take that efficiency that comes inherent in a blockchain structure, keep it for themselves, or they can transfer it onto their consumers. What does that mean in terms of competition around deposits? Well, it's going to increase. But at the same time, the amount of clientele that they're looking at is going to quadruple into numbers never before expected. And why? Because of financial inclusion. Because someone, I'm from Cape Town, South Africa, and I can tell you that 50 American cents goes a very long way. And if you can keep that 50 cents in a very safe place, it is actually usable value. If you cannot keep it in a safe place, that 50 cents is not usable. It basically depletes hope. The ability for you to get up and know that that 50 cents is really not going to do much for you today because it could be stolen, it could be lost, there's an issue with it. gives you no foundation on which to actually try and grow that wealth. But as mentioned before by Yusuf and Paul, the access to the rest of the world is extraordinarily important. And that's where stablecoins really come in strong. Where the Maker protocol adds on top of that is, again, back to financial inclusion, having a look at debt capital. I'm going to mention a Peruvian economist, Fernando de Soto. I'm sure some folks here have heard about him. He talks about debt capital. He wrote it in a book called The Mystery of Capital. He really just asked the simple question, why does capitalism work so nicely in Western Europe and in the US, but struggles around the world? And the long and short of it is that there is too much dead capital. And in fact, De Soto has started tokenizing a lot of assets. Because by tokenizing those assets, you can revive them. And when you're in a developing economy, you have a lot of dead assets. And by tokenizing them, bringing them back to life, standardizing them, you can, in the future, in terms of the application of a protocol like Maker, use it as collateral to create working capital for yourself. So the Maker protocol is not only a place where stablecoin is generated, it is also a place where innovative enterprise can build on top of it that can provide necessary financing.
Amy, please.
Yeah, just to add a little bit, although I might take a little bit of a different approach, and I think you guys have all explained that really well, so maybe I'll take it just a bit higher level kind of conceptual idea around this concept, which is, if you think about, we're moving more and more into a digital economy and more use of the internet to transfer value. It was originally designed to transfer information, but now we're using it to transfer value, transfer information related to value and the finances. And it really wasn't designed for that. And we're building architecture around it to try to do that with encryption and other things. But it's not perfect. We can see that on a day-to-day basis for the last couple of years. I think what blockchain does, by its inherent architecture, uses cryptography, is designed to transfer value. And so now, as we've seen, Bitcoin being the first iteration, had an extraordinary features to do this. In the last several years, it has suffered from some price volatility. So that's where stablecoins come into the picture to try to reestablish that while this industry is kind of growing and evolving, but to be a stable stored value that transfers on this the inherent architecture of blockchain rather than, it's the next evolution of technology.
Thanks. Amy, I'm going to stick with you now, and I'm going to ask you, let's move into some of the legal implications of various structures of stablecoins. Help us understand that framework a little bit, and where, if anywhere, is there existing ambiguity around those laws?
Yeah, I think, when I think about this, and when people talk about it, you have to take a principles-based approach. We've done this from the beginning, back in 2013, when FinCEN was one of the first agencies to issue guidance on this topic. You really have to regulate the activity and not the technology. I think that's the first principle to think about. So you can't just say, well, this is a technology, we're regulating it this way. You have to look at how it's being used. And there are a number of frameworks that do that today. When you think about securities laws, it's a facts and circumstances analysis. When you think about whether anti-money laundering rules apply, if you're in the business of being a money services business, for example, what are the facts and circumstances and the activity that you're conducting to trigger the laws? And the same goes for, there's also this layer of state laws too, and typically state banking departments, which will regulate transfers of value when you're not acting, well, if you're acting as a bank, or even if you're not acting as a bank, you typically have to be licensed in the states to do this. New York and Gemini has gone through this process, has its own very specific BIT license. So those are some, so first I think just that principle that you have to look at your activity and not the technology, or define the technology and regulating it as such. Then I think after that, you have to look, since you're in the value business, the typical triggers of what is it that you're doing. If we're tokenizing a commodity, you should be viewed as being engaged in a commodity-based transaction, and whether that triggers any CFTC oversight or not. There's been a lot of question. The gray areas, when does that cross over into securities law? And there's been some discussion around that. But typically, when you're talking about commodities, I think that's the plans that you have to start with. And then there may be, we've talked about this too, so some of the activity could be as a money services business or a money transmitter, which is on the federal level, you trigger very specific anti-money laundering obligations, and then on the state level, you have banking department licensing.
And for the rest of you, I'm going to come back with some questions kind of around the legal landscape. But first, I want to ask now about some of the risks. We'll start with you, Stephen. I want to work through some of your projects and understand what are the risks with stablecoins. We talked a little bit about collateralization. So what's interesting, what I'd like to get your thoughts on is that that's very promising that you could effectively tokenize all types of different assets. But at the end of the day, you've got to make sure that asset at the end of the token is still there and is safeguarded. So how do we think about that? And what are some of the other operational risks that exist when we deal with a tokenized asset, and how do you mitigate it?
I think the one thing that needs to be made really clear is that stablecoins being applied to the blockchain or any organization that looks to provide some sort of source of value on the blockchain will inherit the normal risks that we find in the traditional world. So if you're familiar with enterprise-wide risk management, you know that everything from market and liquidity risk all the way through to credit and operational, these are risks that will transfer across and you need to manage for them. And how you need to manage for them is really the differentiating point between a centralized offering and a decentralized one. So to that point, I don't mean to sort of just say, well, all risks need to be considered, but it is very important that fundamentally from the Maker protocol point of view, that if you're going to use collateralization as one of the primitives on the protocol, then recourse is the issue. And what we do, what we found from an evolutionary standpoint is you start with crypto native assets. Why? Because you've got price discovery in secondary markets. What does that mean? That means that if the collateral needs to be liquidated, you know where to go and you have a certain amount of confidence in terms of what you can get. Let's turn to centralized real-world assets. Well, this actually now talks to a point which is extraordinarily important, and that is the real value of blockchain is at the intersection of the traditional world and the blockchain or on-chain world. And we've got to come to grips with that. Because if you do, then you realize that the traditional world will start seeing value in the blockchain, and the blockchain will start seeing a transference of organizational value from the traditional world. So when you have a look at the risks, when you have a look at collateralization, you start seeing that using something like a tokenized real-world asset, you need recourse into the normal legal claims process, the normal legal recourse business of the traditional world. So to imagine that you don't need it is really folly. So those risks are there and inherent for us to make sure that we can facilitate this protocol going forward. We need to ensure that legal, operational, credit risk, understanding how you actually come to defining those risks on-chain becomes exceptionally important.
All or Yusuf? I would just say life is a risk. There's always a risk. Who knew? Tokenization, if I tokenize the house can burn down. If I tokenize a car and the courts say that my car is no longer my car, it's my ex-wife's car, the tokenization has to deal with all of these things that are happening in the real world. So there is real risk in talking about tokenization that is outside of the math. Now, the beauty of Bitcoin is all of it is in the math of Bitcoin. The only thing that can fail is math. And so your risks of how the system works are still present because there can be problems in the math. There can be, Stephen's working on a way to break Bitcoin's signature. Once he does that, he's got billions of dollars of Bitcoin. There's those kinds of risks. Some genius can figure out how to break something. But tokenization adds to all of that the fact that the real world is a really, really messy place. And somehow or other you have to resolve, what that means in the token world when things change in the real world. So.
Yeah, as with any business or asset, there's the traditional risks as mentioned, operational, got market credit. Depending on the stablecoin implementation, if it's a fiat-backed stablecoin, or if it's an algorithmic-based or collateral-based collateral-based stablecoin, different specific risks apply. And just speaking on behalf of just a fiat-based stablecoin, some very specific risks are, and some of you may have seen this in articles over the past couple of years, but is a stablecoin truly solvent, right? So that's a question that's been brought up. How do we go about addressing that risk, right? And once again, like the fiat-backed stablecoin, the way we address that is by comparing what's on the blockchain versus what's in these trusted custody partners that we have, State Street Bank. So what we have is to provide that level of transparency to address those concerns or alleviate those concerns. We provide a monthly attestation from an independent third party indicating that truly what is on the blockchain is actually held in our State Street Bank account. So that's one very specific risk. Another very specific risk is this is all based in code, right? So what if somebody puts in some malicious code? What if somebody accidentally puts in a glitchy piece of code? The way we address that is by making sure, once again, you've got an independent subject matter expert. There's no shortage of pen test firms out there looking at your source code. So the source code is open source, right? So people can poke and prod all day. Additionally, having a very focused lens by a pen tester to take a look at that code to see if there's any vulnerabilities. Those are the two specific risks that we've addressed with the Gemini dollar, and those are the risks that have been broadly publicized in the past year or two for other fiat-backed stablecoins.
I don't want to repeat what you've already said. I think that these are risks in the financial services space that are typical. For any time you launch a financial product or service, you need to work through these. And they're being recognized at the international level through the G7 and the IOSCO, which is the Global Securities Commission. And you just need to assess them on a case-by-case basis for each project, just like you would with any other more traditional style product, and work through them. And then understand, at the end of the day, here's the risks that we solve for, and here are some residual risks that you should be aware of.
Please, Paul.
I did neglect that in all the stablecoin world, the new technology, you just mentioned a bunch of regulating levels in the world. We also anyone using stablecoins is also carrying some regulatory risk, because the regulators can always change the rules and impact our business models, impact the agreements that we're making based off of stablecoins and economic value based on those stablecoins. So maybe it's right there along with my ex-wife taking my car and my house burning down. We have regulators who make rules that make my business model unworkable. And so those are also risks that we have.
So Paul, I want to stick with this legal regulatory question. I mean, the way financial regulation typically is applied is really through two lenses. One, who are the intermediaries? And two, what is the product? What is the asset that we're actually talking about? So I'd like to get thoughts. I mean, right now there's a lot of debate about legal classifications. What are these assets? So I want to get your views. What distinction or what difference does it make if something's viewed as a commodity versus being categorized as a security? How does that implicate these business models? So I might, maybe Stephen, I'll start with you and give you the fun question.
That is a good question. I'm also in the right time for that question, I believe. So to that point, I need to re-emphasize again, you have two applications. One being decentralized, that is what the Maker protocol is. And one thing that I just remember from Yusuf is that the Maker protocol is also open source. Meaning it's completely open source. And anybody around here who want to create stablecoin, go look at our repos, off you go. I welcome that. But the differentiation between decentralization and centralization is really important. Because again, from a centralized point of view, we're talking about a counterparty, an organization that issues and redeems, that is their business, that is their function, they need to follow in the regulation that is currently available to us and exists. The decentralized construct needs to look at the activities around it, what I call really regulation on the edges. And that means that if you want to use Ether as collateral, the first place you need to go is to a centralized exchange, go and comply to their BSA, do the KYC AML, and open an account. Use your fiat to purchase that Ether, and then use that Ether to go and place it into the decentralized system. So the edges are where you find the application of regulation. And what's interesting is that on those edges, I would go so far as to, and this is just my data point, not that of the Maker Foundation, is that FinCEN would be applicable there, BSA, KYC, AML. When you have your asset on chain, when you've got your stablecoin on chain, then effectively you have a commodity. And really what it looks at is where the CFTC comes in. So that is my context right now from a decentralized point of view. As to the SEC and its application, I must admit I'm a little bit lost over there. I'm not particularly clear as to what the landscape is that defines them. But in terms of what regulation they have in place, I believe is suitable and makes sense and can be applied. So where the confusion is coming from, I'm not completely clear. I know that a little bit of confusion, but makes it feel like it's a really big one. But at this point in time, from a decentralized point of view, you've got these regulation on the edges and the commodity aspect when you're on chain.
So to answer kind of the question around what would it mean, I think the purpose of a stablecoin is to be a stable store of value. One of the uses being to buy and sell goods and services. There are other uses, I know, Paul, as you mentioned, but just taking that as an example, if a stablecoin was suddenly rendered a security, it is no longer freely used to buy and sell goods and services. It completely loses the purpose for which it was made. And so it's essentially a ban to me if you label stablecoins as securities. And I don't know that it's necessary. When you think about stablecoins, they're designed to have stable value. So that eliminates the expectation of profit, which is kind of a hallmark of a security.
Okay, unless there's anything else, I want to open up for some questions. Let me pause for a minute. There's got to be questions that you guys have. You've heard them a lot. Yes, there's a hand.
So I want to talk about the difference between stable and predictable. Like, we know that the dollar predictably is inflationary, right? And this is counting that to the middle next year. The problem is when we talk about stable, maybe compared to the past, do you mean necessarily holding it stable, or do you mean after
I'll take a quick stab at that, just because the straightforward implementation is a fiat-backed, right? So essentially, it is a predictable coin. It is based off of the US dollar, which bakes in the inflation that is expected. We don't expect to move far away from the dollar peg. So that's a quick and short answer for at least the fiat-backed stablecoin.
To reiterate what Yusuf said, really much applies to decentralized world as well. If you do peg to the dollar, you inherit the characteristics of monetary policy and everything that comes with the dollar. There's an effective kind of dollarization that happens. So there's a broader picture then would be, the sort of subtle implication of the question would be, well, what does it do for monetary policy transmission and stability? And essentially, depending on what kind of coin you're looking at and how you structure it, you either create a credit view or you actually create an extension to the use case of the dollar and therefore create another avenue of flow for transmission and for the necessary stability.
Yeah, and the last point is that if you ever plot Bitcoin against the US dollar, Bitcoin is very, very volatile. If you plot the USD against Bitcoin, USD is incredibly volatile. So one of the things that the blockchain and having distributed ledgers that everybody is looking at the same data is we are actually at the beginning steps of maybe further researching what value even means. And so one of the things that stable assets or pegged assets are going to do for us is allow your business owner who sees a predictable change in dollar also mitigate his risks in different ways, attaching to different values within the blockchain and within those ledgers, as opposed to what they're already doing, which is hedging, swap contracts. There's a whole set of derivatives that are all designed to enable business in the face of inflation. Gosh, I don't want to say that stable values are any sort of derivative, because they really aren't. They're really much, much more basic. But in a lot of ways, if you look at it in a certain direction, it's giving people more autonomy over their value that they hold and the value in which they pay. And because I've got to pay in euros to Europe, and I got to pay in yens to Japan, so making that access to those payment rails easier using the cryptocurrencies is going to facilitate more business and more transparency of that business. Is that fair?
Another question right there? I think we may only have time for one more, so this may be
Hi, Heather.
final question.
Question for Stephen. If you could talk a little more about decentralized and centralized approaches to stablecoins, and you said that they could be very complementary and not sort of worlds apart. In some ways, they're cousins, but at the same time, they are, if you look at worlds apart, especially when it comes to like regulations and all that. So, can you help us envision what this looks like in terms of these two worlds sort of being together and kind of coexisting and being applicable to everyone around the world? Thanks.
Absolutely. So to the first point, I think I made at the beginning, we need a lot of centralized stablecoins, right? Because it gives folks the ability to choose from a consumer surplus point of view what kind of stablecoin they wish to use, right? But as I mentioned before, there's counterparty risk and there is specific entities that issue and redeem. But ultimately, that transaction happens on the blockchain. And while that transaction is on the blockchain, there is clearly the wish to be able to store that value on the blockchain and keep it there. So you could use Gemini dollar, your own chain, and keep your Gemini dollar there. But if you wish to become interoperable, if you wish to go to other organizations, other blockchains, you may wish to go from Gemini dollar to TrueUSD or to USDC. Now, the common element there, almost like the glue that binds all these stablecoins together, and I can even go so far as to maybe say CBDC on a wholesale level, are decentralized stablecoins. That's the thing that basically brings it all together and allows the blockchain to ultimately to make this landscape of stablecoins really work well. And what we need, and it sounds very strange and like a detriment to the Maker protocol, is we need more Maker protocols. We need more because this landscape is undefined, the topology is moving, and the more stablecoins, decentralized or centralized, that come, the more we can start clearly defining what this thing looks like and how it interacts to create a new forming economy on chain. So that's why I think these types of stablecoins are complementary.
All right, so I have time for my last lightning round question, which Amy likes when I do this, but it's a little variation this time. So it's the holiday season. I'm going to ask each of you, what is the one gift that either you want or your kids want this holiday season? What are you hoping for? Stephen.
I have no idea.
All right, well, that's not going to work very well, Stephen.
I want the new Oasis from Kindle. Yes, it's overpriced. Yes, the only thing it does is turn orange and it's waterproof, but man, I want that thing.
2 weeks of downtime, no work, no family, no
It's not realistic for me.
Amy.
There's a skateboard on my son's list.
All right, and Perry, I'm going to pose it to you as well, and you can wrap this up.
Anyone from the SEC, not the Securities and Exchange Commission, but the real SEC. I'm hoping the Gators win the Orange Bowl.
All right, well, thank you, panelists. I'll turn it back
Thank you so much. I really appreciate all of our speakers and members coming in for this. I hope the session was informative to each of you. We have some pamphlets in the back if you would like some more literature